29%. Listings, according to Realtor.com. Some of that gain is because homes are just sitting and not selling. There was actually a pullback in new listings in June. Regionally, sales dropped everywhere except in the Northeast. Strange because home price growth has been strongest in the Northeast. And just a note, mortgage applications to buy a home dropped last week and are down 5% over the past 4 weeks. Sarah?
Okay, Diana, thank you very much. Big story today is the Fed this afternoon after the economic data that we got today. So GDP comes out better than expected, 3%, complete reversal of the first quarter where it's all trade distorted. And this one too, exports subtract from GDP. There was everyone was loading up in the first quarter and they fell this quarter. And that's why GDP was better. Overall consumption at 1.4, good. That's the strength of the consumer, but tamer than what we're used to. What I really pulled out of this, David, because I think this is going to be the debate inside the Fed right now and in the markets, is how are the tariffs impacting inflation? So we got a core PCE number inside this GDP print that showed 2.5%. It was a little hotter than expected, but it's still, as you can see, a step down from where we were.
3.5% in the first quarter.
Correct, right? the quarter before. And we'll get a more precise reading tomorrow with the June PCE number, okay. So the monthly data. This was the quarterly data. But we're watching it because this is the debate inside the Fed. This is why we might see two dissenters with Bowman and with Waller, who have said they've been in favor of a cut as soon as today. Because they feel, first of all, that inflation's not as bad as expected. And if we do see it, it's going to be a one-off where I think more people on the committee, including the Fed chair, are worried about tariffs being more inflationary. And jury's still out. I mean, so far so good. But we don't know. We're starting to hear from companies.
We have a similar conversation and have had it for quite some time now. When are we going to know, Sarah?
Well,
when do we think a sufficient amount of time has passed that the risk has gone down, that prices will go up?
I think what we've heard from the Fed chair is that we'll know more in August, I think, as we get to September, because the market is pricing in a September cut. So by August, if inflation numbers still look tame, it would be a much higher likelihood that they will go in September. But we're starting to learn. Look, Adidas was out today, for instance. Yes, German company, but footwear very exposed to tariffs because we know that footwear and apparel, they're made in Vietnam and China. So what they say is the latest indications of tariffs will directly increase the cost of our products for the U.S. with up to 200 million euros in cost for the rest of the year. We also do not know what the indirect impact on consumer demand will be should all these tariffs cause major inflation. They did talk about price increases.
Did they? I mean, because again, the question is, will they just take the hit in their own margin or will they pass it along?
They talked about...
Are Adidas sneakers going to become more expensive?
Probably. We just don't know how much. And it'll probably be some combination of them eating it and also passing it along. Interestingly, they maintain guidance, so they're not looking at anything. They said, though, they would have raised guidance given they saw double-digit growth.
Right.
So the prudent thing to do was to keep guidance. Mondelez, we're going to talk to the CEO next hour, the company that makes Nabisco crackers and Oreos. We have announced incremental pricing that is going to take effect in a few weeks in North America. I won't elaborate much, but we are clearly at a point in time where we see inflation going up.
That's not related to tariffs.
I mean, incremental pricing, yeah.
Really? I mean, isn't it input costs?
Inflation,
yeah.
Input costs. Yes, food is more local.
Okay.
But look, there's definitely an inflationary impact. They were not talking about pricing increases a few quarters ago because they just didn't have that pressure. Whirlpool, we largely already implemented the necessary pricing action, what needed to be done to offset the tariffs. We know they cut their dividend as well. So I think it's a combination of price increases, feeling it on the bottom line, sharing the burden with suppliers, the suppliers overseas paying the tariffs, and companies are adapting, but it doesn't really give us a read on what it means for overall inflation.
Do you think that there'll be any different language, or that in his press conference that he'll share something that may be different from what we heard more recently from the Fed chair?
Yes, because I think if they are going to set up for a September cut, then he will speak more positively, I think, about what we've been seeing so far on the overall inflation numbers. Certainly there's a risk, and he'll note that there's still going to be inflationary pressures, but that so far the economy has absorbed the tariffs well on inflation. It's a nod to any dissenters we might get and a potential nod to a rate cut that we might get as soon as September. Ironically, the president has been saying we need rate cut, It's too late, Powell, too late, Powell.
Yeah.
What he should be pointing to is actually signs of weakness in the economy that would propel the Fed to cut
But you don't want to do
rates.
that.
You could point to the 1.4% personal consumption and say that was the tamest we've seen. You can point to, the business spending, which actually came down in the GDP numbers, and some of the signs of softness around the labor market, which actually does help the Fed's case. And so the other thing I would be on the lookout today is any language around softening in consumer demand or in the employment situation, which would lead them further to a cut.
Okay. Let's move on to earnings, of course. We got a bunch this morning, and Microsoft and Meta will be reporting earnings after the bell today. That kicks off what will be a crucial couple of days of big tech results. Tomorrow, we're going to get Apple and Amazon. We'll digest those Friday morning. Meantime, Meta CEO Mark Zuckerberg just posting on Instagram. He laid out his vision for AI superintelligence. Said some interesting things about the future. Let's bring in RBC's tech analyst Brad Erickson. He does cover Meta and Amazon. I guess first let's just get to the Meta print this evening and what your expectations are in terms of what we may see there.
Yeah, I think you're going to see really good numbers. Our checks were generally positive through the quarter, so we're talking like high teens growth, probably something in the 16, 17, 18% range. And then guidance, probably the high end right around where the street is estimating for Q3, maybe even a little bit above. Good operating margins. CapEx, always the question. We'll see. Our view there is that to the degree that they can continue to outperform on the revenue front, they probably have room to move CapEx up. Google did it last week. We'll see what they say tonight.
Yeah, obviously those Google numbers as well, I would think, paint a potentially good picture for Meta.
Yeah, absolutely. Search different than social, obviously, kind of intent-based buying versus impulse. But yeah, nonetheless, I think small and medium-sized businesses, which is primarily who drive these businesses and primarily who we talk to in doing our channel work, things were generally good. Prices were going up in the auction, which is a good sign from a demand perspective for ads. So yeah, I think all signs point to good stuff for tonight there.
I wanted to get your reaction to this Instagram post I just mentioned from Zuckerberg, the video just coming out, because it may get to this question about CapEx. He said AI keeps accelerating. In fact, over the past few months, we've begun to see glimpses of AI systems improving themselves. And so he goes on to say, Brad, developing superintelligence is now in sight. And then he thinks it's going to have a more meaningful impact on our lives. It's going to come from everyone having personal superintelligence that helps you achieve your goals. He talks about things like having the glasses to help you basically interpret the entire world. I don't know. Your take on it, whether it means that we may get something unexpected this evening as well?
I like your take. I don't know. The most interesting thing to me that stuck out was he kind of had this kind of altruistically positioning Meta as being really about people and productivity and personal nature of AI, and then kind of threw a little stone in terms of the competitors by saying, hey, a lot of these other things are based at enterprise workforce productivity. And, we're seeing growing evidence of jobs being impacted potentially by AI. It's kind of a theory at this point where it's hard to directly attribute it. But I thought it was interesting positioning Meta as more sort of, tools for the people, for your personal lives. Very interesting.
I mean, he's clearly trying to position Meta as the leader when it comes to superintelligence and AI in general. We've seen the competition for talent with OpenAI. Who else is he competing with? And is it a world where it's winner take all?
Yeah, I think all of the model companies, right? So that's everyone certainly from Google to Anthropic to OpenAI to Perplexity and a number of others. I think those are kind of the primary competitors where you're just trying to add utility in people's lives, right? Like set aside whether it's for work or personal or whatever, you're trying to add utility to people's lives, effectively take up more of people's lives, right? If you're involved, engaged, you can sell more ads, you can drive more revenue by adding more value in people's lives. So I think that's how he thinks about the competitive landscape.
Brad, appreciate it. We'll keep an eye, obviously, for the numbers this evening. Thank you.
Thanks.
Here's our roadmap for you for the rest of the hour. After the break, the CEO of British pharma giant GSK joins us on the back of earnings with a look at the potential impacts of tariffs, including New rates on India.
Plus, we're going to talk to former Kansas City Fed President Esther George. We'll certainly ask her about what she's expecting from Jerome Powell later today.
And we'll talk to outgoing Hershey CEO Michelle Buck about tariffs, inflation, her read on the consumer, following results this morning. Big show still ahead. Squawk on the Street. We'll be right back.
For certain.
Welcome back. Wanted to just take a look at shares of Novo Nordisk. Once was this company the largest market cap company in Europe. Not even close anymore. That was the worst day it's had since 1987 yesterday. And that day in 87 was the crash, of course. Lower again today after the maker of Wegovy and Ozempic replaced its CEO. They actually announced the new CEO. We knew there was going to be a replacement a while back. They cut their full year guidance due to a weaker outlook for the weight loss drugs and the diabetes drugs, citing compounders, citing competition, of course, as well, Sarah, from Eli Lilly. But wow, talk about giving up a lead.
I know. Yeah, and it's funny. Like they had, as I said yesterday, Ozempic was the Kleenex of these GLP-1 drugs. So what happened there?
Lilly came along with Zepbound, with Mounjaro, yeah, and potentially an oral formulation as soon as next year.
Yeah, and it was downhill ever since. Well, let's stick with pharma. GSK is a winner today, posting an increase in sales and profit in the second quarter, driven by strength in its specialty medicine business. The company is confident it will reach the top end of its full-year guidance. And GSK CEO Emma Walmsley joins us exclusively now. It's great to have you, Emma. Welcome.
Great to see you, Sarah. Thanks for having me.
So just give us a picture, if you could, about what is driving your growth in this specialty medicines group. What's working well?
Sure. Well, look, it's obviously great to be reporting another strong quarter. That's 3 years of consistent uptick in operating performance for GSK since the demerger with Haleon. And of course, on top of, at the beginning of this year, upgrading our long-term outlook for the second time. This is driven by specialty medicines, and actually we've got double-digit growth in oncology, respiratory inflammation, and in HIV, so all of our core therapy areas. And we're up in the US, up 17%. And critically, the US is 2/3 of our global specialty business. So all of that's going well. The most important thing, though, Sarah, is the really strong progress we're making in our pipeline of new innovation, i.e. what's to come next. We are on track for a record 5 FDA approvals this year, including in a brand new specialty COPD drug. COPD is the 3rd leading cause of death in the world. A breakthrough new asthma drug, the world's first 6-monthly treatment, a step change in overall survival in multiple myeloma. And then also alongside that, a new meningitis vaccine and the first new antibiotic for UTIs in 30 years. And we're hoping to add to that another 14, well, including those, but 14 new scale medicines and vaccines in just the next few years. It's all about the pipeline of innovation in our industry. That is the secret to bringing down the cost of overall healthcare, and we're definitely making good progress, which we want to add to both organically and with further BD.
But you wouldn't know it given the share price. I mean, yours and the industry. And I know you. I know that you're not, understating the excitement here. I can sense it in your voice about some of the innovation and what you have in the pipeline. So what do you think the street is underestimating?
Well, I've made a habit of not trying to comment too much on the share price. What I'm really pleased is with the consistent upgrade in the outlooks that we've delivered and in our operating performance. When we started the demerger, we had an outlook of 33 billion pounds for 2031. We upgraded it to 38, then again to 40, and I think the market is steadily moving up behind that. Obviously, what matters, not only in operating performance, is the data that comes through in our pipeline. And we're expecting, we had a record 4 to 13 phase 3 readouts last year. We're expecting another 15 by the end of 2026. So hopefully as that data comes through, we'll see the market follow.
One of the overhangs, I think, on the sector has been some of the changes we've seen at the FDA, certainly at the NIH, and what that means for funding. How do you process what this will mean? And do you know yet on your business?
Well, as I said, we're going for 5 new FDA approvals this year. We've already had 3. I think one answer to one of your questions is also, although it's the smallest of our 3 businesses, obviously we have a vaccine business and we're a bit more cautious about the outlook there this year. But importantly, we have had an approval for this new meningitis vaccine, a horrible infection that if you get meningitis, sadly, often within 24 hours, you've got 1 in 10 of our teenagers that will die from that infection if they get it, and 1 in 5 who will live with, life-changing injuries. And we also had the extension of our RSV vaccine to the 50 to 59-year-olds approved. So we continue to engage constructively and are looking forward to bringing this new innovation to American patients.
Emma, it's David Faber. There was a gentleman named Vinay Prasad who had a very powerful role at the FDA for a short amount of time. He's already out. And there was a belief that he potentially, as a gatekeeper to things like approvals for oncology drugs, was going to be very stringent. Is that a relief to the industry, perhaps, to see his exit?
Well, look, I try not to comment on other people's personnel changes. What we seek to do is engage, constructively with the agency, sharing our data, answering questions. And as I said, we're on a pretty good track record of approvals this year, and we're looking for 2 more by the end of the year. First of all, in December, we are really excited about this new 6-monthly asthma treatment. Now, the data shows that depemokimab reduces the kind of attacks that cause hospitalization by over 70%. For anybody who suffers from asthma, that's a pretty terrifying experience. And we've got to remember the burden of the cost of healthcare is often what happens in terms of the cost of of hospitalization rather than the cost of medicines. We're also looking for the approval later this year for our multiple myeloma drug. This is a head-to-head study against the standard of care, gave up to 3 years overall survival improvements. And, we've already had approvals across Europe, Japan, Canada, the UK, Switzerland, and we're really working hard, hopefully, to bring that to American patients too.
As a big global company, as you just laid out, Emma, how do the tariffs impact you? Where are most of your drugs manufactured that are sold to the U.S.? I know you have manufacturing here.
This is obviously a key question. We're all working on it very carefully and watching what's going on. But we updated our guidance for this year to the top end of the range, and we included in that obviously tariffs that have already been enacted, but also those indicated just this week between the US and Europe. The reality is that when we demerged with Haleon, the consumer company, we put a lot of work into redesigning our global supply chain to precisely allow for the kind of agility that this is required. I decided when I began as CEO that we were going to make the US the number one priority for the company. It's doubled in size since we began our business there. It's gone from less than 40% of the company to over 50%. And as I said, in specialty medicines, it's 2/3. We broke ground recently on a brand new facility in Pennsylvania. We all in already have 5 factories. And, I was public last quarter to say that we have in our plans tens of billions of investment in the US, because it is, over the next few years, it is still the best country in the world as a source of and market for innovation. And our commitment continues there.
So, the news today on India, 25% tariff. I know there's a lot of drugs manufactured in India. Does that affect you? And also Europe. You mentioned that the trade deal with Europe, okay, not at all on India, but what about Europe and 15% tariff on pharmaceuticals? What's that going to do for you and overall for drug costs in this country, do you think?
Obviously, traditionally tariffs on pharmaceuticals have been excluded from tariffs, but just because the number one priority is always to secure supply. As I said, in our guidance, which is upgraded to the top end of the range, we have included not only the tariffs that are already enacted, but also the indicated tariffs on Europe. There's a lot more to settle down on this, though, because we have to see the 232 investigation results, which is coming any day, and also the details of how this plays out in the context of any trade deals. But we've assumed it's covered. We'll see what happens. That will have some impact in COGS, but overall it's included in our upgraded outlooks for the year. So momentum is good. We've acted with agility, and we'll continue to respond as these the conclusions play out.
Well, it's a good update. Thank you for talking about all these issues that are affecting your industry, your stock, which is up almost 4% now. Emma Walmsley, it's good to see you from GSK.
Great to see you too. Thanks, though.
Well, Glaxo's not the only stock that's on the move. Don't miss the CEO of Teva Pharmaceuticals. That'll be in the next hour. We'll get a read on tariffs. Quarterly results did as well have a modestly positive impact on the stock so far. Plus, the CEOs of 2 of America's most well-known brands, what Starbucks CEO told us last hour about competition, and a deep dive ahead with the CEO of Hershey, Michelle Buck. Kind of her exit interview, right, Sarah?
Yes, this will be her last.
This will be her last.
Last earnings.
But it's not the last for us. We'll be right back.
Spend, where can we transition between forex and accounts strategically? CFOs are looking at cash as a much more strategic lever in decision making than they had in previous years when cash was free.
I'm sure. We're back to cash is king. Manufacturing, retail, those are two top industries that you mentioned a moment ago with greatest access to liquidity, and they can pull on those lines of credit, or they can choose not to and just say, we don't want to have more debt, for example. But how about next year and the year after? Are they feeling that maybe when they look out 6 to 12 to 18 months, maybe things will improve?
So that's TBD, and it's TBD because of tariffs, right? So when you look at manufacturing, they're specifically interested in what's going on, how do I stockpile? So we saw a huge amount of influx around, releasing capital in order to reposition the supply chain and working capital finance to optimize the position because of the impending and the potential around tariffs. In addition to being the CEO, I also sit on the board of Porsche in Germany, and I'll tell you that automotive is being troubled globally. When you look at the impact of tariffs on GM and Volkswagen alone, talking about $1 billion so far this year, potentially $5 billion by the end of this year, of impact on profitability associated with these tariffs. So when you look at manufacturing and retail, there was a huge influx of supply, and we've got supply chain issues in the first instance. So you take working capital in conjunction with impending tariffs. There's been a lot of stockpiling, and there's been huge amounts of cost associated with labor, right? There's a shortage of labor, there's a shortage of cash. All that combined is creating the perfect storm, really, for manufacturing and retail.
And if you're going to sit on a board, that's a good one. It's right to be on Porsche.
Well, if you love cars or any brands, Porsche is a great one.
Super cool. When we think about also AI and where that comes in, I mean, there's such an excitement about the AI revolution, the manufacturing revival. Yes, the caution is there. At the same time, it's undeniable. Every guest that comes on is just pounding the table on AI, and most of these IPOs, I'd say at least half, because I heard from JP Morgan saying a lot of the new companies or investments are going to AI.
Yeah, but what do CFOs feel about? Let me tell you, we've been doing a lot of research around AI, and we found for CFOs specifically, as it pertains to spend, cash, liquidity, positioning, there's a big gap around CFOs and everybody else. And CFOs are extremely interested. 50% say they want to explore AI more, but 80%, 8 out of 10 say that they're nervous. There's a bit of a trust gap between, how far can I take that trust? Where do I get the data from? How do I utilize that data in decision making? So 5 out of 10 are excited about transformational AI, but 8 out of 10 are extremely cautious about how they utilize that data to make trusted decisions.
And truthfully, if you make a decision with AI, it's so new, you don't really have a track record. You don't really know what you're getting into to a certain extent. And while you want to be innovative and forward looking and show that you're tech ready,
that's right.
I mean, you don't want to destroy a good foundation for a great company.
AI is heavily built on previous trends and historical evidence and proof, right? It's machine learning. Machine learning means you have to learn from history. AI is taking the amalgamation of years and years of data and history. But guess what? The world's changing day by day. The one thing that we don't know is that we don't know. And the ability to predict and give insights utilizing AI is more difficult than it had been maybe ever before. However, because the world's changing so fast. However, being able to utilize AI in which to create predictable insights, being able to model, for example, what if I do get hit with tariffs? I mean, you look at automotive, 27.5%, right, of inbound for the U.S. way of tariffs. It's a huge amount relative to 15% for other industries. And be able to model what that could mean, what it could impact for 2 or 3 years down the road when it comes to the supply chain and working capital finance is incredibly impactful.
All right, so overall signaling a tightening liquidity position for U.S. Corporates overall. Melissa, it's great to chat with you.
Thank you for your
insight
Thank you very much.
on what these large U.S. businesses are doing. Melissa DiDonato, thank you.
Thank you so much.
Coming up next, Chartmaster, and we'll preview some of the... No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading.
reporting earnings, and we want to make sure to cover these as well. Jenny Horn doing so much research here on Lam Research. Good morning to Jenny Horn, Rick Ducat. Let's start with Lam Research. Jenny, please.
I feel like right now a lot of these names, as you mentioned, are being overshadowed by, of course, the behemoths that are, all things Microsoft, Meta platforms, and Amazon and Apple. But these are still really important names and do have influence to impact the overall market because of the read they give on AI and some of the status with the various mass spending that's being poured into these technologies. So for Lam Research, we are expecting some pretty healthy top-line growth of roughly 29% year over year, improving from the roughly 21% pace of increase they recorded in the same period a year ago. Adjusted earnings per share expected at $1.20. But so far, the street sees nothing but a pretty strong sales outlook. As Jefferies highlighted earlier this week, Lam Research is poised to benefit from the increasing demand for DRAM and NAND flash memory, primarily driven by, again, AI. The surge in demand is also expected to lead to an increase in CapEx commitments from major technology companies, which many do believe Lam Research is now well positioned to capitalize on due to its leadership in wafer fabrication equipment. So their CEO did emphasize their strong execution at a pretty critical moment for the semiconductor industry as a whole. They've been focused very much on this advanced deposition and etch applications, as well as, which is increasingly important in wafer fabrication, but also it's a strategic move that does align right now with their industry growth demands for higher performance within their chips. So geographically, important to note that China makes up around 31% of their total revenue, followed by Korea about 25%, and then Taiwan about 17%. So system revenues also account for about 60% of those overall revenues, while those rose by about 9.7% in the prior quarter. In contrast, though, their customer support business group was up 40% to 40% of their total revenue. That actually was a 20% year-over-year increase. So growing with some different mix that we've seen historically from Lam Research. But I will say that when looking at DRAM and NAND flash memory, there's still a ton of demand there and the opportunity for growth, which they have been seen as capitalizing on. So we're expecting some pretty strong results from a name that trades at roughly 24 times its forward earnings. So it's actually not unreasonable as far as its valuation.
Okay, thank you for that. Good luck there. Right now, the stock's sitting exactly at $100. Rick, what would you say about the chart here?
I mean, sometimes the price action can be fairly consistent and straightforward. That's kind of what we see here. We have this trend line going up across these lows shortly after the price shock event of the April tariff news that we saw that brought the stock to its 52-week lows near about 56 or so. But from there, we're up 78%. We notched some new highs near 102.59 just recently, but have since backed off. You can see, though, our channel that we were talking about earlier that connects all the lows that we saw in this upward trend here, but actually pretty closely followed along with our yellow 21-day exponential moving average as well. Moving averages support during uptrends, resistance during downtrends is how they're commonly viewed. We have now tested the moving average. We've held on so far, but our trend line has been broken. Now we have this low point near about 96, our green line here. That's kind of where we saw some congestion and where price bottomed out a little bit. That's a notable downside area to watch. RSI also declining here. Price has broken through our trend line. We're more drifting sideways now. Momentum is slowing down. We can see as well, if we were to consider our volume profile and standard deviation channel studies, the +2 standard deviation channel right about here matches up pretty closely with those old highs. So about 102.60 or so to 103.30. That would be a general resistance area to consider. Not too much in the way of volume though, but this small node does line up with our 21-day EMA. So about 98 to 96. Those are the downside areas for many traders likely will have their eye on.
Okay. Thank you for that. Next up, should we take a look at ARM Holdings? It also reports its earnings. We want to get some details there. Jenny has all the details and the fundamentals.
Well, the good news for ARM is over the last 2 years, they have beaten their earnings and revenue estimates 100% of the time. So it's not a bad track record. But I will say that so far, what we've heard from these semiconductor peers like NXPI or ASML with international exposure specifically, as this company is, of course, based overseas. We have not seen the same boom and really strength following earnings that we have maybe in some of these U.S.-based chip stocks. So something to keep in mind. On earnings right now expected to contract about 12.5% year over year. Revenue is still expected to grow, though, about 13%. And so far, I mean, again, the street's fairly optimistic. A KeyBank note highlighted that they said positive forces, including some upside to iPhone builds. Their negative forces, though, per KeyBank, include slowing Android smartphone demand in China. So the UK-based company does make its money by selling licenses to chip designs to semiconductor companies like an Apple, a Qualcomm. ARM's latest, though, advanced chip technology called the ARM v9 generates higher royalty rates than its previous iteration of the ARM V. So it's also making progress in some of the high-end cloud server processor market by selling its various chip technologies to like Microsoft or NVIDIA. So this name, I do think, does tend to have a great read on some of the spend and the ways in which the capex is being allocated from these tech behemoths. So ARM has been interesting for that reason, a compelling story, one of our best performing IPOs of just several years ago, but now trading at 92 times its forward earnings. So the risk here is growth is expected. Can they deliver remains to be the question.
And I do see Morgan Stanley with a 194 target, and ARM is at 164 today. UBS has ARM and a price target of 185 and a buy rating. So that's some good news there for some of these names that think there's upside potential. Rick, take a look at the chart, please.
Right, so this one also has a pretty strong uptrend off the lows. In this case, the percent gain is even greater, 105% from that point here, that price level of 80. However, this chart is perhaps a bit more of a question mark in terms of the upside. Look at 165, our red line here. That's about where we topped out previously. We weren't really able to stay above that level with any consistency at all. That was the site of a big breakdown point here. You can also see just in this area the declining highs, lower highs and struggling at a good sign here. But now that area has come back into prominence once again. That's roughly where we topped out recently here. That's roughly where we are right now. So 165 is a standout upside level that could result in potentially breakout activity here. For now, though, we're still within our channel here. Our moving averages are still trending upward and diverging, not really seeing signs of trend slowdown or breakdown, I guess I should say. RSI, on the other hand, is showing a bit of a momentum starting to falter somewhat here, trending downward, but now leveling off as we head into earnings. So momentum winding down is pretty common when a stock approaches an earnings event here. So that could be just a factor playing into that situation here. If we were to look a bit further to the upside, 170 is our +2 standard deviation channel. So 165 and 170 are some upside levels you could watch. To the downside, 21-day EMA here, near about 156 or so. Then we have our volume area. Our heavy volume point of control is around 140. The low extreme area to watch for, around 136.
Okay. Thank you for that. Appreciate it. I mean, and they just
ตึกถล่มมาแล้ว
hugely in demand for data centers. So their strategic spinoff of their flash business, or SanDisk, does also focus on this durable hard disk drive growth. But risks do still remain, as with, all of these companies. It does still face some flash volatility, as well as heat-assisted magnetic recording delays, which is otherwise known as their HAMR technology, as well as solid-state drive competition and some cost-sensitive right now applications that are perhaps weighing on their overall market share, but still a name that has looked really strong, especially this month from a chart perspective.
Okay, thank you for that. Should we take a look here at the technicals, Rick, at this chart?
The strongest move, and really kind of the most straightforward chart, just shooting upward, 28.83 the low, kind of the same point for all three of these companies. They're closely related, but from there you can see it's really been kind of a different story. In this case, up about 146% from those lows here, making new intraday highs today, even as we speak here. The only real standout level to the downside that's anywhere near the current price activity is about here, this green line, 66.50 roughly. That's also quite close to our yellow 21-day exponential moving average there. So that could be a downside confluence to keep in mind if we do start to break below this channel type shape here. Our lower boundary would be right around maybe the 68 level or so. RSI gives us also something of a mixed picture though, because on one hand we are declining. We were seeing a little bit of bearish divergence. Price was making new highs while RSI was trending down, but the RSI was in the overbought area for most of it. So that's a sign of strength, typically, of strong momentum here. So even though the momentum was quite strong, it was waning. As I said, though, we're approaching earnings and we're breaking out today anyway here and making new highs. So that would be often regarded as maybe a more bullish type of situation here. So plus 3 standard deviation channel, 76.62, one area to look for to the upside here. And as I said, that area near 66.67 to the downside really stands out.
Okay. Thank you both so much. A good look there at 3 important names due to report every day. We have Chart Master, where Jenny Horn combs through these fundamentals. Rick Ducat takes us through these charts. Jenny, Rick, thank you. After just a quick break, we'll take a look at this day thus far. Our market with us, and a GDP print which really showed growth at 3% rate in the second quarter. That was certainly interpreted as some good news. George, some of your thoughts?
Well, I think it was really good news. I think if you look at the print, compare that to Q1, it's a complete turnaround. First off, if you look at, there was an expansion or a plunge, if you will, of imports by 30%, and that counters the 37% increase in imports for Q1. The other thing to keep in mind is personal consumption was higher. If you look at Q1, it was around 0.5%. This quarter, or Q2, they printed 1.5%, so that was a significant improvement. The other thing that was cut back in Q1 also includes government spending, and that was reversed. If you look at the numbers for this Q2 print, it was a 0.4% increase versus a 0.6% decrease in Q1. So all of these variables, if you put it together, demonstrate improvement in GDP above consensus, coming in around 3%. And I think the consumption component is extremely important. Overall, there seems to have been a lot of fear, I suggest, in Q1, maybe because of the tariffs, which were really starting to be announced around late January, early February. And that might have pulled back consumption at the very least in that quarter. But net imports, which again are essentially negative towards GDPs, rose significantly in Q1. So we're seeing that back off in Q2. Really good print. An economy that's growing 2.5% to 3% is growing at trend.
Understood. I mean, Sam, what's on your radar here?
Yeah, well, as you say, I mean, the reaction off the back of what we got this morning, we've got plenty of information, as you mentioned, Nicole. We have got the S&P 500 ticking up just fractionally, putting on 0.2%. It does look like the Russell 2K seems to be outperforming there as far as the small caps. You've also got the yields picking up as well. If you take a look at the Dixie as well, it has ticked up higher. So that really seems to be the positioning off the back of the information we got as far as the GDP is concerned. But as you say, very much ahead of the FOMC meeting and what we're likely to get from that. It seems that the talk out there is the fairly, what some have described as a muted response to the GDP numbers, seems to suggest that there are a lot of eyes on what Fed Chair Jay Powell has to say. Not to mention also, we're waiting. Another thing that we're keeping an eye on is that Trump's word on this China trade deal, or perhaps not a deal, but the tariff pause extension, because that really is up to him now. So we have actually seen him taking to Truth Social this morning, talking about that the GDP was better than expected, too late, must lower the rate. So no doubt more pressure being piled on the FOMC, but there has also been some suggestion that whatever we get later from the Federal Reserve, some are suggesting keep an eye on the banks, because we could see some movement there. Not to mention, of course, we have had a number of earnings too, and it's a bit of wait and see mode ahead of Microsoft and Meta as well.
And yeah, exactly. So we have a slew of earnings still piling in, over 150 companies this week, George. And while folks want to be optimistic, I just had a great conversation with Melissa DiDonato about companies and the liquidity that they are holding. And in fact, they are putting aside more because they are feeling cautious. I also was reading through a Charles Schwab study about retirement confidence dipping some. They have some inflation concerns, responding by saving a little more, cutting some of the spending, and making sure to keep with their 401k contributions. So people want to say up, and away, but they're a little apprehensive to do so.
No, sure. I mean, if you just look at the position of the Fed, they're essentially creating an environment which we haven't seen since the great financial crisis, and that is net interest rates, or interest rates excluding inflation, is higher. So there's a premium on yield right now. So everyone's looking for the central bank to cut rates except the bankers, and the bankers are doing very well right now, I suggest. Now that's creating some consumption apprehension, but it really is a wealth transfer that the Fed is creating that is buoying, if you will, savers, if you will, but also bondholders. So there's a big transfer that's going on from traditionally from debtors to creditors right now, and that hasn't been the case since the financial crisis, up into the point where we had the inflation spike post-COVID. But there's a lot the Fed can do to ameliorate this, especially on long-term rates. They could talk about, and this is what I'm going to be looking for in any comments, is what they plan to do with the balance sheet runoff, because they can stop the increase in long-term rates by reducing the balance sheet runoff at any point in time.
All right. And look, I mean, I'm going to continue to watch all things crypto, too. I had a great conversation there. Saw more bullishness for the likes from Ethereum and Bitcoin from our last guest there. How about your final thoughts, Sam?
Yeah, I'm just sort of looking at the sort of movers and shakers as far as some of the top gainers and top decliners, particularly when you look at some of those that have reported earnings. I mean, you've got the likes of Humana, and you and I were talking about this earlier this morning, which is one of the top performers today, sitting up almost at 5% off the back of what they've been saying, which has really been a little bit different to what the other health insurers have been saying. But then you've got the likes of, obviously, Mondelez on the way down about 6%. So, you know, we are seeing some individual stories based on some of what they've been saying around their earnings.
All right. Sam Bottas, George Sillis, thank you both so much. Huge day on Wall Street. Keep it tuned right here to Schwab Network. We have you covered. I'm Nicole Petalides. This is Morning Trade Live. Trading 360 next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Of Market on Close. All right, let's get some insights on the news that's shaping markets. For that, we want to welcome in Omar Aguilar, CEO and CIO of Schwab Asset Management. Omar, thank you so much for joining us in person. We are so happy to have you here today. All right, let's talk about overall market momentum recently. We've continued to see this grind higher when we think about the S&P 500, the tech sector, NASDAQ 100. There's still some risk factors to keep in mind, and the question recently has been, is this valuation justified? So when you think about where markets are now, how long do you think this resilience can last?
Well, the markets seem to be driven by where the economy is going. And our U.S. economy continues to prove to be incredibly resilient. You know, a lot of that driven by consumers. Consumption continues to be fairly strong. We continue to see a significant support coming by the labor market. I think between the jobs, reports, between just the overall, health of the job market, we continue to have a very, resilient economy that is driving where the market's at. That being said, markets are priced for perfection. The market seems to be going through everything is going well and is somehow ignoring a lot of the noise that is still up in the air. It wouldn't be a surprise to me that you going into the second half of the year, we see more volatility. So, okay, before I get into your thoughts on potential for volatility in the second half of the year, Omar, I want to ask you about the job market. It has held up better than expected. And a lot of times you see kind of a shrugging off of ADP data. That doesn't seem to be the case today. That report coming in much better than expected. I want to say I'm a little surprised by the resilience, but not completely, because there is the view that AI on the front end is a jobs creator. What do you think about that? It is interesting because, the other part that drives the market is earnings, and earnings continue to be very solid. Yet the expectations were low in going into this quarter, but, companies for the most part have continued to deliver good numbers. The interesting part about this is that the fact that profit margins are starting to shrink, and that goes back to your question about labor market. So far we haven't seen corporations taking actions in terms of reducing cost or reducing labor. In other words, people are not necessarily losing jobs. There haven't been that many job openings as they used to be, but certainly the market is not necessarily weaker. I think the labor market seems to be fairly strong in just keeping, their employees employed. I mean, that's a big part of what they are. Yes, capital expenditures, especially in AI, have actually increased over the course of this year. Yeah. So if you think about where CapEx is going, a lot of that goes to AI, and that has actually helped in the job market. Okay, that $85 billion was a number that stands out to me when it comes to Alphabet, Google, and we'll probably hear more about that when we get Meta later today. Let's talk about your view on volatility for the second half of the year. What are you looking for as it relates to a trigger for that? Well, there's, we try to quantify this in four areas. The economy. We should expect a slowdown in the economy. We had great numbers today, even though they were not surprising because of the activity we have in the first quarter. So these second quarter GDP numbers, seem to be just a bounce from what we saw in the first quarter. And a lot of it related to, pre-purchases coming from, anticipation of tariffs. Pull forward. And pull forward, right. So that's the first piece. So it's the economy. The second part is earnings. As I said, profit margins are to be squeezed. That's going to be coming either because corporations will, pass through the consumers, or they will have to reduce costs. So profit margins will have a big part of volatility going into the second piece. Employment. The labor market will be a key, driver of what the Fed may do in monetary policy going forward. And lastly, inflation expectations that may drive, bond markets yields up. Okay, so when you think about today, what's in front of us, we get a decision on rates. The expectations we're not going to have any movement, but what will the tea leaves tell us about what's to come? What's your expectation for the path from here, especially given that at least these last data points that the Fed gets in today, GDP, that's stronger than expected. So overall, the economy is holding up. Even the job market, I know it's not the non-farm payrolls report, but it is an indication that the job market is holding up. Where do you think that leaves the Fed?
Well, the Fed is probably in the best position they could be in at the moment, given they're in a tough spot, but this is probably the best that they could be. And yes, we don't expect any decisions on rates in this meeting. They're also not going to be updating their dot plots, and a lot of the discussion that we'll have in the Q&A session for Jerome Powell will be related about anticipating of the first rate cut. And that may happen between now and the end of the year, and a lot of that be as a result of the labor market and inflation as part of the mandates of the Fed. Now, having a strong GDP and having I would say, stable labor market are probably the reasons why the Fed will not have to anticipate. The key driver of the future Fed discussions will be what we will have later this week of the PCE numbers that are the ones that may drive, inflation expectations for their own Fed committee.
Okay, I want to go back to the points you were bringing up or the patterns you're looking at when it comes to fixed income. Within fixed income, where do you see opportunity as it relates to both duration and credit quality?
Great question. So far, if you think about it, the corporate America has very strong balance sheets. We have seen these, already in earnings reports, and therefore you see corporate, bonds being very tight, and spreads are very tight. What that tells us, and what you tend to tell investors is, there's really no reason to go into the bond, yield and the bond,
into
junk
the long,
bond,
okay.
into the higher yielding, because the spreads and the probability of outperformance taking that additional risk is not worth it. There's very attractive yields in the corporate part, in the high quality part of the market, without necessarily having to go into high yield. Second, in terms of duration, there's still a lot of uncertainty in the market. We haven't gone out completely of the uncertainty related to trade policy. And as I said, there is a potential for inflation expectations to go higher. So it is advisable to stay neutral to your own liability benchmark. So whatever is your duration you have today, there is no reason why you need to just go. The belly of the curve is probably the safest. You don't necessarily go there. Yeah, 3 to 7 years. You don't necessarily have to go too far out. You don't necessarily go on the short end because we anticipate the Fed to potentially reduce rates.
I want to circle back to equity exposure and put it in this context, U.S. versus international. Where do you see that positioning now? The S&P 500 has started. I mean, we're hitting records. It's catching up to what we'd seen, where you'd seen some outperformance in international. How much exposure now to U.S. should investors have? Yeah,
let me be clear. International investing is always a good opportunity. And I know that for the last 15 years, the U.S. has outperformed international, but the sources of diversifications are always something that investors should pay attention. U.S. investors tend to be underinvested in international, and therefore opportunities to always look for other places to diversify the investments are important. This year, the weaker dollar has actually helped in outperformance of international market. Second, the European economy has actually, developed and has posted really good results. And when you look at the earnings coming from Europe, especially because of spending in defense, that has actually given them a very nice support for the economy to continue to perform. So we will encourage clients to continue to find ways to diversify their assets, because in many cases, because of that outperformance of the U.S., they have been overexposed to the U.S. than what they have international markets. And lastly, if you look at the composition of these markets, the U.S. tend to be a little more tech heavy. When you look at different international markets, you will have more exposure to financials, to other parts of sectors internationally that are also attractive.
Yeah, a little more tech heavy because of the weighting, essentially, of those mega caps. All right, we'll have to leave our conversation there. That's Omar Aguilar, CEO and CIO of Schwab Asset Management. Our thanks to Omar for coming here on set with us here at the New York Stock Exchange. We've got a lot more to come here on Trading 360. Next up, it's the big three: 3 stocks, 3 charts, and 3 trades. Rick Duquette goes through the technicals, and Don Kaufman takes us through the trades. On his list today, Netflix, Citigroup, and Nike. That's next on Trading 360 here on Schwab Network.
fairly significant. Look, at this point, like, I'm not all bared up in here. I'm just hopping on trend, and it does look like it's the beginning of a trend. As such, I'm going to take a bearish position inside of Netflix, but I'm going all the way out to the October 17th expiration, and I'm going to give myself the benefit of that duration in this trade to look for Netflix to cross literally to 1100. The trade itself, the OC17 expiration, again, OC17, I'm going to be buying, okay, the 1110 puts. Again, buying the 1110 puts, selling the 1100 puts. So it's a $10 wide put spread done for a $3.33 debit. It's big, it's bearish, it's lovely if you are on the bearish side, trend following right now inside of Netflix.
All right, Rick, take us through what you notice about the chart. I mean, Don makes a great point. This is all about the trend right now. What do you notice in the patterns?
Yeah, sure. And it seems like Netflix is at one of those inflection point type of areas where there's the potential for a downside breakout here. What I mean by that is 1160, our green line here. This was an old high point here. We topped out around that same area twice. Now it's where price is kind of consolidating and moving a little bit sideways here. So 1160 could be that breakdown point potentially here. Price also moving downward in a relatively narrow, tight channel type shape here between our two white dashed lines. We've crossed below our two moving averages, yellow 21-day, orange 63-day exponential moving averages. They're both starting to turn downward to sideways as well. These are signs of impending trend shift here. The longer term the moving average, it's more significant when it crosses and changes its slope. We can also see, if you were to think more literally in terms of momentum, RSI has been trending down for quite a while since those highs here. We are below the 50 midline. There's potential to break out above that red trend line here, but we would still be looking for a crossover above that 50 level for more of a bullish shift here. To consider some other levels here of interest, we can look at our volume profile study. We can see here that this area, there's a volume node here around perhaps 1190 to like 1220 or so. That also holds our moving averages as well. So that's an upside area to watch. But then to talk about Don's trade, he mentioned that 1100 level. That's the same level I had my eye on here as a notable low point. This was a couple of lows. That's also where the volume really drops off quite sharply here. That would be another of these kind of make or break type points.
Okay, all right, Don, I'm going to move on to your next trade. You've got Citigroup on your list. Like many in the financials, it's been an outperformer year to date. But where does this trend take you?
Yeah, this trend right now, this is wild to the upside. What else can you say about Citi? You got to recognize this is 70% move off of those April lows, 70% straight up. There's been almost no pullback. And one of the things Rick is actually going to show here in a moment is probably the RSI, which is incredibly overbought, starting to actually roll over right now. And I'm going to go for it. I'm actually going to go for it over here. Look, I think that the price action in Citi is stalling out right now. It's ripe for the pluck, and I think we're going to see some sell-side activity in the product in the very near future. Look, I'm not all bared up with no place to go here in Citi. I'm actually going to take a little bit of a shorter duration bearish position here. I'm going to go out to the August 29th expiration again, August 29 expiration. I'm going to be buying the 94 puts, selling the 89 puts. So it's just a $5 wide put spread. This one's done for $1.50 debit. I like to take these shots, especially when an underlying is kind of stalling out. Look, somebody's got to be the first one over the wall. And in my case, I'm going right through it. Yeah, I am stepping in the way of what has been a freight train to the upside.
Okay, so potential stepping in the way of a freight train here. Rick, what do you notice about this chart for Citigroup?
I guess just first, the general thought is that, those very one-sided areas can have very lucrative opportunities if it does play out, the way that doesn't really exactly fit that consensus here. And in this case, to kind of speak more specifically, momentum has been slowing down here. We can see the RSI has been trending downward here, showing bearish divergence, price making new closing highs, RSI making lower highs here. Not typically what you want to see here when things are getting stretched out here. We are hanging out above this green trend line here. We are still in the overbought area here, but this would be one of those other situations where, we're not trying to predict the future. We're not saying this is going to happen, but we're saying just very quantifiably, momentum's slowing down. The pace of the gains is not accelerating really anymore. It's winding down somewhat here. So now we can see here an important areas during our climb to the upside. 85 was an old high point here. That was about where we had our breakout point, and we didn't quite retest that area, but that one sticks out. Same thing here, that 89 level, retested and continued on. Now, if you were to think about it as well, we had like bull pennant, bull flag type shapes here, these consolidated phases. What you would hope if you're bullish would be a push above that 96, 97 level. What you would think if this was a breakdown point would be a retreat further down, perhaps to like that 89 level that we mentioned here. If you were to also assess our volume nodes, not really too terribly much help in this case here. The best we can do is see that there's some heavy trading at these current levels down here near 85 as well. Matches up with those old high points.
Okay, Don, a quick thought from you on, since you're kind of stepping in the way of what's been a trend recently, what's the preparation for if this doesn't go the way you expect it?
Well, the nice thing is it's a $5 wide spread. I'm paying $1.50 for. So, the risk reward in here is absolutely phenomenal. No stop order, none of the kind. I mean, when you've got $1.50 at risk, your risk management is effectively taken care of. It's one of the primary reasons that I use these types of spreads. But, I'm actually looking at this trade specifically today inside of financials because I don't necessarily think the financials are going to like what Jerome Powell has to say. And that could actually have a broader impact on most of the financials, the XLF included.
All right, and let's talk about the final trade on your list. That's Nike. Look, Nike has had a lot of challenges. Year to date, it's barely above the flat line. So where do you take this trade from here, Don?
So completely anecdotal, but I actually chose this trade because I bought some Nikes earlier this week. I haven't done that in a long time. Strictly online because they don't have a Nike store. I'm down in the Eastern Caribbean over here. My on-cloud's completely melted basically because of the heat down here. So I'm back to Nike. And I was looking at the underlying simply because I was thinking about Nike. Anyway, 80. 80 has actually been some long-term resistance, as Rick is actually going to bring up in the chart here in just a moment. And if this thing can get above 80, I think it's got legs to the upside. And that literally is a trade unto itself. I'm also going to use a nice, call spread in here, bullish call spread for the risk reward. So I'm going all the way out to the September 19th expiration. Here's another one where I've got to buy myself a little bit of duration. I'm not sure I'm going to be right immediately, but I think if it get above 80, as I said, it's going to have legs. So Sep 19, I'm going to buy the 80 calls. Again, buy the 80 calls, sell the 85 calls against it. So it's $5 wide call spread done for a $1.18 debit.
Okay, all right. Rick, take us through what you noticed about the patterns in this chart for Nike.
Yeah, for sure. I mean, 81 is the level that I actually marked on my chart, but 81 is extremely similar territory, especially if you were considering not even like stock price, but like strike prices. That's pretty much the same area here. But to backtrack, the reason I picked it, it was the low after this gap, low points here, high points here. Once again, had trouble breaking above there. Now we're approaching that 80, 81 level once again here. And there are some other signs that are rather interesting. We can see that a long-term downtrend beginning with those highs, our blue line here. We did test it to the upside. Now we've seemed like we have broken above it here. We have also pushed above this 74 level. A brief series of highs there before we had a gap downward there. That gives us a boundary to watch as well because it lines up with our trend line and our moving averages here. 74 all aligned in that same spot to the downside. That's a notable downside area. We saw once again here some bearish divergence on the RSI. Still holding up okay though, still in bullish territory, still trend line is intact here. And it's kind of interesting right now because if you were considering a bullish play in Nike here, we're getting a bit of a pullback below our trend line and we're filling this gap right now. If you were thinking in terms of gaps, the gaps often get filled, then what you would hope if you were bullish would be that we would continue on up to the upside once again here. So this is perhaps a potential opportunity in this area. Not saying you should or should not do it, just pointing out what I see. And volume profile point of control, 77, right around where we are now. So this would be a key area to hold between like 77 to 78 or so.
Okay, all right. Don, I'll give you the floor. Any final thoughts on Nike?
Not specifically on Nike, but the market as a whole right now. We're at a critical inflection point. I mean, this week, specifically today, obviously there's the Fed earnings in scope. There's a lot of volatility actually priced into this marketplace. And we're again, I think, ripe to see the lows of volatility just basically happen possibly yesterday. Look for volatility overall to start to pick up as we turn the corner in summer, start to head into August.
Okay. Okay, well, you're echoing the comments we heard from our very own Omar Aguilar earlier today, expecting some more volatility in the second half. All right, thank you. That's Don Kaufman of Theo Trade and our own lead market technician, Rick Ducat. Coming up next, we're going to spotlight today's Fed announcement ahead of that announcement, and we've got several ETF trends for the current environment. Trade 360, we'll be right back.